In this week's video, we'll review the hard evidence to answer this vulnerability question. We remain in a tentative market, which means reviewing the big picture remains prudent. We'll look at risk on versus risk off in 2014 and compare that to 2008, which is a bear market, and 2011, which is a stock market correction. Try to discern between the two. We'll look at momentum, trends, opportunity costs, and revisit that long-term breakout chart. Flexibility is always important, but even more so when you have a tentative and indecisive market as we do now. As long as the S&P 500 stays above 1844 and below 1878, it is extremely important to remain flexible, nimble, and to keep an open mind. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In a recent article that covered the need to perform some Quadrant 2 investment activities, we noted that back-tested systems help investors sleep better at night. This is a partial screenshot of the master CCM market model as of the close on Friday, March 28th. The model does numerous things, but the most important thing is recommending a prudent exposure between risk assets such as stocks and conservative assets such as bonds. If you're running a trading system or an asset allocation model, especially a model that allows you to hold positions overnight as any investor would, if you can answer this question in the affirmative and you can do it on a consistent basis, then you have a good model. The question is, based upon what I know about the markets, am I taking a prudent level of risk? And that's how you sleep better. Knowing what I know about the markets and studying charts for years, having a risk exposure or an exposure to equities, given what we know today of roughly 62%, and having a conservative exposure to offset the vulnerabilities of roughly 30%, those are good sleep at night numbers. That's exactly where we should be based upon what we know. We can migrate in this direction and reduce risk if the S&P 500 takes out 1844 and 1848, if we can make a new high and hold it above 1878, and especially if we can hold it for more than a few days, then we can take some of this conservative money and redeploy it into equities or other assets that look attractive. This is one of the monthly risk-on, risk-off charts that feeds into the CCM master market model. We use the concepts on this chart to review 4 other charts. So if you're a regular viewer, bear with me as I explain some of the concepts. We've got stocks versus bonds here. This is the S&P 500 relative to the aggregate bond fund. The ratio here is in black. When the ratio is rising, it tells us that the demand for stocks is greater than the demand for bonds. Conversely, when the ratio is falling, it tells us that investors are defensive and the demand for bonds is greater than the demand for stocks. The moving averages in blue and red help us discern between volatility to ignore and volatility to respect. This is what's known as a bearish moving average crossover. All it tells us is that the probability of bad things happening on this chart increase when we get blue dropping below red as it did here. You can see this is 2008, this is 2009, and the look of this chart early in the bear market process, this is the S&P 500 here for illustrative purposes only. Blue starts to turn down, there's a no, red rolls over, blue below red, the slopes are down and prices below. We have a full bore bearish look in here where the S&P 500 was still trading at 1470 It lost an additional 54% after the observable evidence started to deteriorate. How does this chart look today in March of 2014? The answer is much better. The trend is still clearly in the favor of owning stocks relative to bonds. We do have some slowing momentum and a lower high here that's concerning, but this is a full bore bullish look. Price above blue and red, and the slopes of blue and red are up, and blue is above red, telling us that if the stock market does indeed pull back, the current profile probably calls for a correction rather than a new bear market. Obviously, we always keep an open mind. Now we're taking the same concepts and we're moving them to a weekly chart. This is stocks relative to bonds on a weekly basis. You can see blue is still above red. We have somewhat of an indecisive look, but for the most part, this still favors, as it sits now, owning stocks over bonds. And that's why on the conservative side of our portfolio, we have cash for the most part and not bonds at this point. This same ratio on a weekly basis, this is the S&P 500 here, obviously looked much worse. This looks a lot better than 2008 when very bad things were happening in the stock market. So this is a bear market look, and this is a correction look. You can see as the stock market was basing here in 2011, foreshadowing this waterfall decline here in stocks, the ratio was already raising yellow flags. This is a full-bore bearish look for the stock market, a full-bore bearish look. So for us to migrate to more of a defensive stance in March of 2014, which we may have to do, this chart needs to morph into something more with a look like this or this, where weakness in the stock market followed. We're using the exact same concepts here, so we'll move quickly. This is a weekly S&P 500. Blue is still above red. For the most part, that's a mixed but bullish look, and we're still holding this bullish breakout. If this deteriorates, then we'll reduce risk. Exact same profile for the most part as we would expect with long versus short, still favoring growth assets over conservative assets. And we've already looked at the stock bond chart that is still maintaining a bias towards equities over bonds, but obviously showing some indecision and consolidation that tells us to be open to weakness in the stock market. This is the long-term chart of the NYSE composite that we've been following over the past several weeks. This is a 7-year bullish breakout dating back to 2007. You can see that this still favors the bulls. This is 10,301. It was the highest close on a weekly closing basis. We've been hovering around that figure with the market telling us that it's important, but as of this week, we closed above it, which leans towards the bullish camp and calls for exposure to equities as long as it holds. This is the exact same chart, except we're looking at a monthly version with highs and lows. 2007, the intra-month high, or the highest high, was 10,387. We're currently above that closing Friday at 10,434, but you can see this candlestick, which may be difficult to see. If you zoom in, you can see it has a wick up here and an indecisive look. So we'd like to see a close at the end of the month above 10,387. This is our weekly momentum for the S&P 500 that we track. If you're new to the fold, this is momentum here. As long as momentum stays in overbought territory, the probability of good things happening increases. Conversely, when you get a weekly close that drops out of overbought territory, the probability, and probability is the key word in everything that we do, the probability of bad things happening increases. This chart might sum up the whole situation. Still in overbought mode, bullish. However, falling this week from a momentum perspective, with the S&P 500 dropping roughly 8 or 9 points over the past 5 trading sessions. We've got a lower high here and a lower high here. This is a bullish and vulnerable profile. If it morphs into something like this, then the market model will have us reduce risk. If we recapture a more bullish look, we may redeploy some of our cash. Continuing with the mixed bag theme, same exact concepts, but now we're looking at technology stocks that look worse. We do have a close below, and we have a much more vulnerable look here. The market has held here in the past, so we'll keep an open mind, but this chart too fits in with the bigger picture. Still above the 22-week, which is typically bullish, and the slope is still up. If you follow Dow theory, one thing that would go a long way in making us feel a little bit more confident about bullish scenarios would be if the Dow Jones Industrial Average can make a new closing high here, which it has not done yet. This is a lower high. This is a lower high. This also fits in with the indecisive type look. Price is above the 50-day moving average, but you can see the intermediate term trend is looking weak here. If you're a bull, you want to see a new high. If you're a bear, you want to see price drop below the 50 roll over. And if you want a bear market to surface, you want this to flatten out, which is the 200-day, and price to drop below it. And then you'd like to see blue drop below red. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.